Excellent. Thank you. So we can get started then. Welcome everyone to our panel discussion that is co-hosted by the Consumer Finance Initiative at Sloan and MIT and the Golub Center for Finance and Policy. As you have seen from our announcement, what we want to talk about today is the changing consumer finance landscape in the US, and of course in particular prompted by a lot of the changes that are happening at the CFPB but also other regulators. And we want to talk about this topic from the perspective of finance research and what we know about consumer financial protection, but in particular with an eye towards how different type of regulators interact with each other in this changing landscape and where we see basically some of the fault lines. And I'm joined by four excellent speakers on that topic, all the way from research to industry. Let me just very briefly introduce my co-panelists. On my very left is Jonathan Parker, who is the Robert C. Merton Professor of Finance at MIT. He is also the co-director of the Consumer Finance Initiative here at Sloan and the Golub Center for Finance and Policy. In addition to many academic accolades that Jonathan has, which I will not embarrass him with right now, he is also actually an economic advisor for the Congressional Budget Office and has been a special advisor on financial stability for the Office of Financial Stability. So he has seen the academic as well as the regulatory landscape. Next to him is Christopher Palmer, who is an associate professor at MIT at Sloan. He teaches corporate finance, household finance. He's also a research associate at the NBR and an affiliate at the Jamil Poverty Action Lab. And he has done a lot of research on credit market, financial decision making, and retirement savings. To his left is Bob Pozen. Bob is the former chairman of MFS Investment, a mutual fund company in the United States. He's also the former president of Fidelity Investment and has served, for example, as a member of George W. Bush's Commission to Strengthen Social Security. Since 2020, he has also been an adjunct professor at MIT Sloan, and he's also a senior fellow at the Brookings Institute. Now, last but not least, we have Paul Willen, who is joining us on Zoom. Paul is a principal economist and policy advisor at the Federal Reserve Bank of Boston. He has done a lot of research on real estate, mortgage markets, consumer financial decisions in those markets, and in particular with the view on decision making in financial crises. Paul has also, of course, been very involved in policy making, especially in the mortgage space, and he will talk to us about some of the things he is learning right now from the policy perspective as well. So the way we will now handle this panel is that all co-panelists will take about 7 minutes to give different views of where consumer financial protection stands at the moment. And then we will go into Q&A with the panel and then Q&A with the broader audience. All right. With this, let me ask Jonathan to kick us off and give us a lay of the land, what actually an agency like the CFPB typically does and how it affects the consumer finance landscape.
Okay. Thank you very much, Antoinette. So let me start with the CFPB. Why does it exist? What does it do, and why is it shut down a pretty big deal? So the CFPB came into being following the financial crisis, the subprime crisis, and the Great Recession, and it was part of the Dodd-Frank legislation, which addressed two main failures in the system. The first was the focus on systemic risk in the financial sector of the United States and its measurement and regulation. So that was clearly at the heart of the financial crisis. But also at the heart of the financial crisis were consumer financial products, the mortgage market in particular. And so a bunch of the Dodd-Frank and the existence of the CFPB is partly motivated by dealing with those issues. And the idea is to create something like the Food and Drug Administration, but for consumer finance. So the FDA approves drugs, says what's legal, how to sell them, how to have prescriptions. It keeps the food that you eat safe so that you don't have to walk into the supermarket and know which manufacturer has made the product and try and judge whether that manufacturer has made it safe for you or not, or it does have hidden ingredients for you. The FDA kind of takes care and regulates that. So the idea of the CFPB is to do the same but for consumer financial products. The CFPB has regulatory authority primarily over the large banks, those with over $10 billion in balance sheet assets. That's about 150 banks in the United States. And over the fintech space, the entire consumer finance and fintech space. And that's why it's kind of a particular interest for us here at Sloan in that sphere where we do a lot of innovation and a lot of consumer finance and fintech work. The small banks and medium-sized banks are regulated by other regulators pretty well. The CFPB is what's called an administrative agency. And so it has two main purposes. The first is rulemaking, which is interpreting the legislation passed by Congress and signed by the president. What does it actually mean in practice? And what does it mean in practice given that the world is constantly evolving? We're innovating new financial products and the like. How do the rules apply in that space? And it has legal authority to issue these rules. I'll come back to that in a minute. The second big thing it does is enforcement. So it enforces a bunch of consumer financial laws, things like fair lending. It deals with complaints. It accumulates complaints. That's part of what leads it to instigate enforcement actions. It also does some education, and it does some research. So let me start with rulemaking. What is rulemaking about? So the Congress passes a law, the president signs the law, and the CFPB interprets that law and makes legally binding rules. So what does it mean that, for example, you can't treat people differently with your lending based on their race? That's a basic fair lending decision. The Congress says you can't do that. And so a bank wants to know, well, suppose I'm looking at default rates, and default rates differ by race, and I'm making loans based on default rates. Is that allowed under the law or not? And the CFPB will come in and do some rulings and tell them what is and is not allowed. That seems relatively straightforward. A more complicated version of that is there's a fintech that has a new algorithmic lending procedure that also happens to have disparate impact by race. Is that going to be allowed or not? So you have all this new data you can take advantage of. You have a new fintech. You're doing this lending. How can you make sure that your lending is compliant? Well, the CFPB can come in and evaluate and set down rules that are then legally binding that tell you where you can and can't go and how you can innovate safely in this space. Okay, how does they do that? How do they issue these rules? Well, they have to be consistent with what's called the Administrative Procedures Act, which means they collect comments, they carefully document their rulemaking, and they make a reasonable argument for why this is the way the law ought to be implemented, given the vagueness of the law and the new situation at hand. That's very important for the financial sector to operate efficiently, is to know what those laws actually mean before we just end up in the courts and in a big mess. A bank can sue. Now, that's not consistent with the law. The way the CFPB has done this is wrong, or a fintech can sue. And traditionally, the courts give the regulatory agency a preferential treatment, a deference, provided they follow the Administrative Procedures Act, that their ruling actually has some credibility. That doesn't mean it doesn't get overturned, but they have the benefit of the doubt legally. Recently, a Supreme Court ruling has overturned what was called the Chevron doctrine, so that is no longer the case. And that means that any rule issued by the CFPB now is more apt to be challenged. Any change in rule is more apt to be legally challenged correctly, and especially one that is imposed without the full administrative procedures. So if you shut down the CFPB and you're going to issue a rule, you're clearly not going to follow the rules. It's likely that a lot of rules making that is done now is going to be highly legally questionable, which is, again, a great source of uncertainty for the financial sector. The CFPB also has legal requirement to produce some things that allow the businesses to function. So one example of that is the average prime offer rate. It's a table of interest rates that, provided a bank makes a mortgage on according to this table, it can be a qualified mortgage, and they can assume that the borrower has the ability to repay. So they've got to check a bunch of borrower boxes, issue one of these rates. The borrower has the right to repay. Good, you don't have to check it. If you don't have that rate, or you're not issuing according to that rate, you could be liable for making an error and issuing a debt contract to someone who does not have the legally required ability to repay. You could be sued. The CFPB produces that table weekly. When the CFPB was shut down, that table didn't get produced. The mortgage market panicked, and they had to reinstate some of the people at the CFPB to produce this table. So that's one of its key requirements. So that's rulemaking. Lastly, enforcement. I'll just talk briefly about enforcement. The CFPB has a tip line, it has the power of subpoena, and it brings enforcement actions and class action lawsuits and penalties against financial institutions that are violating these rules. An example of a case that I was potentially going to be involved with, the CFPB was suing a bunch of large banks for their use of Zelle. They steered their customers to use Zelle for payments. Sometimes the customers lost their payments, sent them to the wrong person. The bank didn't provide any support for recovering those funds. The CFPB said you can't just dump that all off to Zelle. It's your customer, you steered them there, you're responsible. So there was going to be a court case about that. And the CFPB was the one bringing the action against the large banks on behalf of the consumers. Another example about rulemaking and enforcement that's really important that we may come back to, buy now, pay later. The buy now, pay later space, you guys all know, it's a big pace of innovation with fintech. The CFPB has said we're no longer enforcing any of our previous rules and regulations on buy now, pay later. The last one, open banking. The first Trump administration started the process, required actually under the Dodd-Frank law, to set up open banking, meaning that financial institution that has your data, you own your data, you can authorize its sharing with any lender or any other financial institution you'd like to do that with. It's a complicated process because that information is also highly confidential and it's subject to security regulation. Fintechs want access. The banks who own the data don't really want to share access. And so this process was a complicated process, started in the first Trump administration, was reaching the end of a rulemaking process that was expected to conclude in the next year. We're going to have a framework for open banking in the United States. We're going to have a more competitive financial sector. All indications are that the Trump administration, in shutting down the CFPB, is not going to issue any ruling. And so Section 1033 of the Dodd-Frank Act from more than a decade ago, 15 years ago now, maybe never going to get implemented. The result of all of this is there's an enormous amount of uncertainty for the traditional banks. The big banks, they're talking to their compliance departments. The compliance departments are saying everything is the law, you have to adhere to it. The fintechs, they're operating in new spaces. They want to know what the law is, and they don't know what it is. So the banks, there's no enforcement, but they're supposed to still adhere to the law. There's not a lot of responsibilities. The fintechs aren't sure what's legitimate or not. So there's a huge amount of uncertainty right now in the financial sector as to what the playing field is. And that's why the CFPB matters, and that's why there's a little bit of chaos now in the consumer finance and fintech space.
Thank you, Jonathan. Maybe that's now what we'll do is zoom out even a bit further, and Christopher will talk about in a more idealized from an academic perspective, right? Where have we seen consumer finance matter, or maybe also people making mistakes in the decisions that they're making, and what drives those mistakes? And we should also be clear, of course, right, that some regulation has cost, and where do we see the trade-off either going one direction or the other?
Good. I want to talk about those trade-offs. I want to talk about the role for research in this. I'm going to zoom out briefly even farther and go back to Adam Smith for a second. So like we're talking 18th century. So if you think about what Adam Smith was talking about with the invisible hand and laissez-faire economics, it was basically saying that it's hard to improve on the equilibrium that happens from the free market. The free market kind of gets it right. In the years since the 18th century, we've been much more scientific in economics, trying to specify the conditions under which that's true, under the conditions under which it really doesn't make sense to intervene and to have government intervention or regulation, because we're likely to just kind of get things worse than they would have gotten anyway from the free market. So you might think from a naive reading of economics that we're all anti-interventionist. I would say that on good days, we are all just requiring a scientific justification for the intervention. It's fine to say there's a market failure, the conditions are not met for the free market to get it right, we need to intervene, but we should be precise about what's happening there, and we should think about what the trade-offs are from any kind of intervention. So that's the zoomed out, really macro view of things. On a micro view, what does that look like? Okay, so let me just mention to you what some of those conditions are that we require for the free market to get it right. So the ones that are perhaps most relevant to thinking about consumer finances would be things like perfect competition, perfect information. There are no behavioral biases. Everyone operates rationally, and that markets are complete. Anyone can get the products that they need, and they have access to contracts that will insure them against all kinds of different states. If those things are not true, and in practice, they're in the realm of corporate consumer finance, they're often not true, then you can have a welfare-improving government intervention. So I thought I'll just take you, and the role for research is to document, are those market failures operating? If we fix them the way that we propose to fix them, is that actually improving things? What are the distortions? What are the unintended consequences? So I really think about research and consumer finance around those lenses. There's been an intervention. It's addressing some sort of market imperfections, some sort of market failure. Is it worth it? Do the ends justify the means? Are we moving things to be a little bit better? So I thought I would just highlight a few consumer products where you could think very concretely about those assumptions. I was thinking about student loans and credit cards, auto loans, and then Jonathan's Zelle example I think is pretty good. So let's start with auto loans. This is a domain of consumer finance near to my heart. If you've ever had the experience of buying a car, it's hard to shake the feeling that you're doing this once every 5-10 years, and the person on the other side of the table is doing this 10 times a day. And the cards are stacked against you. And at the end of the car negotiation, you get sent into the back office to deal with the finance and insurance guy, the F&I guy. And there the cards are stacked against you too, because he has perfect information, and he can often even see a perfectly competitive market that's bidding for your car loan, and you know none of this. On his screen faced away from you is all of the information about his cost of issuing you a car loan, and he looks at that and then he sizes you up and he decides how much he can mark it up. And you're not exactly sure what the distribution is of the cost of capital for those lenders. You're not exactly sure what the distribution of interest rates are. You have behavioral biases that lead you to prioritize just thinking about, well, this monthly payment looks affordable. It must be a good deal, because you're thinking about budgeting and you're thinking about the short term. So you're not acting fully rationally. And then you have limited ability to kind of for recourse. So where would the CFPB step in for this, and what would economists do that were studying these sorts of issues? The CFPB would step in with rules for fair lending and say, okay, that person in the back can't look at you and say, I bet because you're a woman, I can rip you off. Wouldn't say this out loud. This is the process in his head, right? And so I'm going to charge you more. That would violate the fair lending statute, and they would be subject to examinations that would uncover this, lawsuits, penalties, liabilities. So that's where the CFPB would come in and say, this isn't a situation where there's perfect information on both sides, where there's perfect competition on both sides, where there are complete markets, and so we're going to try to help in that case. If you think about the situation for Zelle, where were the market failures that led to the lawsuit against Zelle, and why was the CFPB potentially having a role to step in? The people that were participating in Zelle didn't have full information that there was risk of their payments being lost. They had behavioral biases that led them perhaps to overtrust their banks as being a very safe provider of money transfer services. And the market was incomplete in the sense that they didn't have very good recourse without what we used the CFPB for, was helping provide them that recourse and helping provide some liability for the banks that had engaged in this negligence. Okay, one more example would be enforcing rules around credit cards. Credit cards are famous as being kind of ground zero for where our behavioral biases get a cash and they're able to buy things, right? So it's easy to rack up a lot of credit card debt because we like to shop and we are tempted by sales, and it's easy to overspend. It's also easy to underestimate the lifetime cost of interest. So for example, paying the minimum payment for the next 15 years for a stereo that people don't buy stereos anymore, but a TV that you bought would actually cost you a lot of money, right? And so we have regulations to overcome those behavioral biases to try to make that more salient. So what's the role for research in these domains? We want to come in and say, we made a rule that says you have to have a box that explains how long you'll be paying interest if you pay the minimum payment. Is that box on your credit card statement effective? Does it lead people to spend less in interest? Does it change people's decisions? Do people regret those decisions? We think about what's happening with car loans. We could think about research that's going in and trying to say, are there interventions that could make this market more competitive, that could promote us being closer to that equilibrium where those assumptions are met for the market to get it right? So that's what I think about when I think about the research that's done at the CFPB, the research that's done in academia that is often convened by the CFPB, by their conferences, by the economists that are there, and by the research that's digested there, as we're trying to get at these balances and these trade-offs, and to do that scientifically.
Thank you, Christopher. That's great. And we will come back to this afterwards with more examples and more details about where the trade-offs sometimes can bite, right? And where they protect maybe one set of consumers but have spillover effect on other type of consumers. And then the really difficult decision is, of course, whether the cost on one side is worth the benefit on the other, right? Which is often the problem in making good regulation. But I now want to shift the lens a little bit and broaden our discussion in another direction. What I mean is that we want to now talk with Bob Pozen about how other areas of where consumer finance is important, in particular retirement savings, financial advice, brokers, how they are regulated and how the regulatory space there is evolving and kind of affecting consumer choices.
Sure. So many more years before the CFPB board, the SEC started investor protection, which is another form of consumer protection. It started in 1933 and been going since then. I was an official of the SEC in the 70s, and there was this very big distinction between brokers and investment advisors. Brokers were only, their duties only attached when they made a recommendation, and then the criterion was that the recommendation had to be suitable. Investment advisors, on the other hand, had a full fiduciary duty in all aspects of the relationship. And interestingly, I think the research has shown that most customers didn't know whether they were dealing with a broker or they were dealing with an investment advisor. They were pretty much in the dark. Now, in the last 5 years or so, there have been a lot of rulemaking activity at the SEC to define more clearly what the role of a broker is and then what the role of an investment advisor is. And the SEC adopted in 2019 a regulation called the Best Interest Regulation. And that goes beyond disclosure, and it requires that you identify conflicts and try to reduce them. Most importantly, it says that you have to have a reasonable basis for your recommendation, and it has to be in the client's best interest. So that's a shift toward a much stricter regime for brokers, and that's been on the books for a few years. Now, at around the same time in 2019, the SEC had interpretive rules in which it elaborated what the fiduciary duty of investment advisors were under the Investment Advisors Act, and it delineated a duty of care to act in the best interests of the client, not only in recommendations, but in custody and execution, to monitor performance. And it specifically said you can't have a general waiver of this fiduciary duty by contract, and you can have a waiver of specific parts of the duty, but only then with full disclosure and informed consent. Now, the third group here is investment advisors for retirement accounts. So those are governed by ERISA, and there's been a huge amount of debate over the years about what are the criteria for qualifying as an ERISA fiduciary. And it used to be the case that there was an exemption, effectively, if you only gave advice on a one-time basis, it wasn't regular, and second of all, you were able to say that there wasn't a mutual understanding or mutual agreement, and that got you out. So now that's all pretty much changed. there's no longer this exemption for one-time advice. If you give advice, it is for compensation, which is broadly defined to include not just fees but commissions. Then you do have a trusted relationship with your ERISA fiduciary, and that fiduciary is actually subject to the most stringent rules out of all of consumer protection to act as a prudent expert and solely in the interest of the customers. Now, all of this was elaborated under the Biden administration, and I think it's fair to predict that the enforcement of all of these rules will be much less under this regime. So, but compared to the Consumer Products Financial Commission, at least they're still existing and they're still operating in this sphere. So I'll stop there.
Great. Thank you very much. And I think this is also really a space where we're starting to see a lot of research about the trade-offs between tighter regulation of financial advisors that then, of course, raises the compliance cost and indeed makes it a bit more expensive for competitors to come in and competition to occur in that market, right? And we understand as economists, especially I think in financial advice, we have basically seen that a lot of the fintech startups, once they started growing, were actually then ultimately either had to join forces with existing large financial advice companies, right, and asset managers, because the compliance itself is costly, right?
Yeah. I think the one thing that's clear from the research, and that goes back to my old days at the SEC, is disclosure alone isn't that effective.
Exactly.
You can give people large things. If you have a financial advisor, once a year they'll give you several pages. I rarely have ever met anybody who reads the pages. And so I think the movement toward best interest, federal fiduciary duty for investment advisors, ERISA, these are all trying to move away from more than disclosure and trying to have an obligation on the part of the entity to look out for the best interest of the customers. And personally, I think that's the only way it's going to be effective.
I agree. And actually, I personally always like that type of arrangement of the regulation because it kind of stipulating best interest clauses, because it gives firms still a lot of flexibility in how they serve their customers.
Correct.
Because, we don't want just meticulous little rules that then limit how the financial advisor interacts with different clients that they have. So this is kind of obviously zooming out to the broader landscape. So finally, we will come to Paul Willen, who will talk to us about, in particular, the mortgage space, and again, how the view from industry, regulators, and research is on the changing landscape in mortgage finance. Paul, go ahead.
Okay, thank you, Antoinette, for inviting me. This has been very interesting for me so far. So let me start, though, by saying that I come to you today as a researcher and as a concerned citizen, and not as a representative of the Federal Reserve Bank of Boston or of the Federal Reserve System. So it's important, especially now, to emphasize that. So I'm going to focus on mortgages for two reasons. One of them is that it's what I like to think I'm an expert on. And then the second reason is, of course, as Jonathan mentioned, the proximate cause for the creation of the CFPB was the financial and foreclosure crisis of 2008, in which mortgages played the starring role. So I'm going to focus on discussing the framework of regulation rather than the regulations themselves. So I think it is possible for us to separate those two topics. So, for example, I was never a big fan of the ability to repay rule, but I think we can discuss the framework for implementing the ability to repay rule, whatever we may think of the rule itself. So with that in mind, let me talk a little about how the framework is evolving. And as Antoinette mentioned, after Antoinette asked me to be on this panel, I decided to call around and ask regulators and industry participants how they felt about the, I have the word evolution written down here, but there's another word that rhymes with evolution that might describe what's happened to the CFPB. And the answer is that that lenders are quite anxious right now. And part of that is, of course, that the CFPB in place in January was the devil they knew. And lenders, like everyone else in the economy, generally don't like uncertainty. But it goes beyond that. You know, of course, nobody likes to be regulated, but from what I can gather, lenders actually seem to be fairly positive about the CFPB and about how it was running. And in fact, I think they may have even kind of liked it. And there are many reasons for that, but I'm going to focus on two of them. So one of them is that lenders actually like consistent, aggressive enforcement. And so without enforcement, what they worry about is, and of course, there's some bias in who you're talking to, but the lenders that kind of like to think they play by the rules feel that without enforcement of the rules, the lenders willing to break rules will gain a competitive advantage. And so there are two examples that lenders talked about. One is, an example of this is the loan officer compensation rules. So after the financial crisis, the Dodd-Frank and then the CFPB instituted rules that govern how loan officers are paid. And the idea was to ensure that a loan officer doesn't benefit from making a borrower worse off. And these rules changed all the ways in which loan officers were paid. And, you know, loan officers, it does restrict their ability to do business. So some lenders now, without any enforcement, will start ignoring loan officer compensation rules, and that'll make it much easier for them to recruit loan officers. And so I think the firms, the lenders, the big ones who feel that they generally try to play by the rules feel like this is going to put a lot of pressure on them. Another one is the issue is the Real Estate Settlement Practices Act, which is RESPA, which governs conflicts of interest between lenders, real estate agents, title agents, and there are all kinds of limits on what you can do. So for example, lenders are not supposed to pay real estate agents commissions for delivering customers to them. And again, this is something that lenders are worried about, which is without a regulator to enforce that, what's going to happen to, basically what they're worried about is there's going to be a lot of pressure on the good lenders to start breaking the rules because other people are getting away with it. And to some extent, they say it's a little bit like 2005 when people started doing all kinds of crazy stuff. And basically, if you didn't do it, you would cede market share to the people who would. So that's the first reason that I think they like the CFPB as it is. But the second reason, and this goes to the question now of what's going to happen, is that an assertive CFPB, the CFPB was sort of highly respected in the consumer protection space, and that kind of kept state regulators in line. You have to remember that mortgages are regulated both at the federal level and at the state level. And so, so with the CFPB, lenders, the states generally, even the more aggressive states, generally tried to stay within the framework. And so particularly they worked through the Conference of State Bank Supervisors to basically come up with a consistent set of rules. And banks really, or lenders really like that. They don't want to have to deal with 51 separate sets of rules. And so this goes to the question of what's going to happen right now. So with the CFPB staff being cut from 1,700 to 200 employees, the CFPB is essentially a spent force right now. And so who picks up the slack? And the answer is it's the 51 state regulators. And and so as evidence of this, just about how it's fracturing regulation of banks, the outgoing CFPB head, so from the Biden administration, has already given a call to arms to state regulators, basically to take up where the previous CFPB left off. And so now, instead of having one reasonably, one kind of assertive regulator, you're going to have all kinds, 51 different regulators pursuing 51 different agendas.
Yeah, Paul,
Okay.
I was going to ask you, before this, the CFPB, as you know, the bank regulators were the ones that did a lot of the consumer protection rules. Is that, one could hypothesize, rather than it going to 51 states, that people like the Fed and the control of the currency would step up since they're now doing this for the smaller banks, and they would do this type of regulation for the larger banks as they did before 2008.
You can read my mind.
Yeah, the point is that's exactly what the CFPB was designed. Basically, the Fed lost its consumer protection role because it was sent over to the CFPB.
Yeah, but is it going to get it back?
No, that's the point. The problem is it was through statute. There was a sense that the safety and soundness mission of the federal regulators and the consumer protection mission, which is in some sense true, right? One of them is protecting depositors, and one of them is protecting borrowers. And we know the borrowers' and depositors' interests are not always perfectly aligned. The more you can extract from the borrowers, the more you can pay the depositors.
And vice versa.
So the point is, part of the idea of Dodd-Frank was to separate those two.
Exactly.
But
The ability of the Fed right now, our staff, our consumer protection staff, that most of that responsibility, just as an example for researchers, the Home Mortgage Disclosure Act, for example, used to be managed by the Fed. That was moved over to the Consumer Financial Protection Bureau.
But the bank regulators still administer these acts for smaller banks. And so that's my question about whether they would build on
right,
that.
but and also just remember, most mortgage lending is not done by banks. That's the other.
That's the other piece.
Exactly.
Yeah.
So that is the important point I also wanted to raise, right? That the lending space in mortgages, for example, has expanded.
Right.
And actually, if Jonathan was also bringing up before, right, say buy now, pay later. Right. So even in, say, what we think credit market on consumer credit, right, the landscape has also is expanded, and so it makes it hard for a regulator like, say, the Fed to step in here. So, but I think this is
it's a good
right?
point, very good point.
Yeah, so this was actually a point I was going to ask actually the rest of the panel too, is where do you see, or do you see opportunities in some products for other regulators to take up the slack? Now, we talked a little bit about mortgages already, and what are the areas where you are most concerned, so to speak?
A big question.
It's a big question.
I suppose when it's fraud and abuse, the FTC naturally has overlap with the CFPB and doesn't need a change in statute to continue to look at fraud and abuse in product design.
But only in securities products. So if you don't have a security.
Sorry, not the SEC, the FTC.
Oh, FTC. I'm sorry.
Yeah.
I thought you said SEC.
Yeah.
Yeah.
It's just a lot of fintech regulation. Payments would be an example. Things like the account aggregators, which send money to different banks. Once the money's in the bank, the regulatory framework is fine. But when you're the record keeper and you're allocating accounts to different banks or transferring among them or aggregating accounts, there was a fintech that put money in whatever the highest yield bank was overnight each night. It was growing well, it was doing fine, and then it didn't, and it went under. And people were like, okay, I want my FDIC-insured deposit back. And the lender, the fintech that they were dealing with wasn't there anymore to answer the question, so they didn't know whether the deposit was in Arizona or Kentucky. Which bank is it at? Well, it's FDIC-insured somewhere. That was no help. And so the CFPB was sort of stepping in and coordinating the regulatory responses to make sure that something was advertised as an FDIC-insured deposit would actually come out to be an FDIC-insured deposit as from the depositor's experience, user experience. And so innovations like that now no longer have sort of safety rails and guardrails, and that should worry consumers of financial products. That should also worry the innovators, because gaining that trust is always the first huge step in any financial product innovation.
Right. I just say I'm not counting. I mean, the FTC is also controlled by the administration, so I'm not sure. I'm not sure that they're going to be the cavalry to come into the rescue.
Right. So it's in a way a more politicized or politically aligned agency, and that's why the CFPB, right, in its original statute was meant to be unpolitical, and also, I think this has become clear in our discussion already, right, it was actually meant or designed to have a lot of research functionality, right, so that rule making was always associated with better understanding of the product in the market where it was indeed intervening, if we want to say, right? Yeah. So actually to limit the unintended consequences, which is actually something I wanted to now come back to, which is this idea that, in markets where the consumer is limited, meaning where the consumer doesn't know how to shop for the best products, either because of inattention, behavioral biases, lack of understanding, right? That's where competition alone just fails the consumer. But of course, we don't want to be in a command and control economy either. So I wanted, kind of come back to the panel and ask you, where have you seen examples where regulation really improved the market, and where might you have seen, consumer finance regulation, whether it's CFPB or whether it's in the brokerage space, that actually helped competition to focus on, if you want, the right dimension of products that actually are an improvement for everyone in the consumer space. So I can give you an example, given that, I was on the CFPB board myself, and I've done a lot of work on credit cards, right? What we have seen in the credit card market, if you look at what happened after the Dodd-Frank Act, we had regulation to curtail the amount of nuisance fees that can be imposed on consumers. So it was, before the financial crisis and before Dodd-Frank, banks were allowed to charge up to $39 or sometimes even more for falling late on your credit card, even if it was $5 late, right? And so you can say, is it really the case that the credit risk of the bank was going up so much that it's justified to charge a $39 late fee? Maybe not, right? Maybe yes, but that is something that we really should want to test. Because it is possible that if we curtail the ability of banks to charge late fees, then suddenly they're stuck with a lot of really bad customers, right? And there's, for example, very interesting research in that space also by myself and by my former student, Scott Nelson, right, that shows that regulation, when you really carefully look at it, has had two effects. On the one hand, it really helped to protect people who are good credit risks, but a little bit inattentive. Because those are the people that often got hit with these type of nuisance fees, and in a way were just transferring resources or rents, if you want, to the bank. Because they were being charged with this high fee, even though they were ultimately paying again. And in fact, the banks often knew, because they had seen it in the past on their track record, right, that they were good payers. And therefore, it wasn't somehow that you needed to charge them so much, because it was an indication that these people were going, kind of now going to default on you, right? So for those type of customers, that regulation was a huge boon, if you want. right? I mean, it was designed in a way to help them. But it is also true that there is a subset of customers that falls late because their credit risks start changing, right? And if you cannot charge high late fees on those type of customers, on the one hand, you're not disincentivizing them in actually engaging in this type of behavior, and you're not allowing a bank to actually charge for the increased credit risk. And so what the research has shown is that there is a subset of customers for whom it was just net good that this happened, right? Meaning the inattentive customers. And actually the bank didn't lose serious amount of money because of it, because these weren't risky customers. But then there's this subset of the customer who actually, once they started falling late, really started defaulting. Those are the ones then where the bank, by not being able to charge them now high late fees, were actually themselves incurring more cost from these customers. And so the research, if you think about it, right, the analysis has to be, first of all, to identify these type of different groups, their relative size, and then to understand when we impose this kind of regulation, right, which of the two groups is the bigger one, and therefore on net, which one is actually dominating how the bank experience the bank and the rest of the customers of the bank, of course, right? Because if the bank cannot charge the late fees to the people that actually will default, it has to increase the fees to everyone else, right? And what we see here is that regulation actually, in the end, was net good for the entire customer space, because it mainly helped to reduce nuisance fees on people who were inattentive but wouldn't fall late in the end. And it was ultimately not so, the group of people who start falling late once in a while, and then the late fee helps you to mitigate their default risk, is just very small, right? So you see, this is kind of some of the complexity in that space, where a well-intended regulation, right, has benefits on some dimension, can have cost on other dimensions. We really, in order to see what is good regulation, right, we need to understand how this affects the space.
I love this theme of trade-offs that you've hit several times. Just as a small footnote to your junk fees, my term, not yours. You were very professional in not using the term junk fees. This that happened with the CFPB recently, I think this illustrates things. They were in the final stages before so much of the disbanding of finalizing their rule on overdraft fees. And the analogy was very direct and very inspired by your nuisance fees research and by Scott Nelson's nuisance fee research. And there's a trade-off when you have really high overdraft fees. That's because there are some chronic overdrafters that actually incur a lot of cost for the bank, and it's a lot of risk. You're going to have this money, and they're going to write a bunch of liabilities, and you're going to end up covering some of those. And so there's some credit risk that happens from this kind of risky depositor. But then there are many more that, like, it's the sequence of checks that just kind of cleared in a way that they ended up overdrafting, and they got hit with this high overdraft fee, which was then a downward spiral for them, because if they are basically have an overdraft fee and because they didn't have any money in their bank account, now their bank account's even more negative because they got hit with an overdraft fee, then it's harder and harder for them to swim up into solvency. So they had done the research on this, not just making the casual analogy, but trying to figure out, is this actually the case? Is this actually harming consumers? What are the fraction of consumers that seem like they're just being harmed and they're not actually constituting material risk for the bank? And who are the consumers that are actually quite costly for the bank? They had done this. They had solicited comments. They had done research on it. They had crunched the data with all of their economists. They were just about to finalize the ruling, and then all of this kind of evaporated. I think in general, this is the place for research, and some of these other regulatory functions that the CFPB absorbed and combined, they were all of a sudden able to have, we can pay the fixed cost to have a research department that thinks about these trade-offs very carefully, that acknowledges that when you regulate products, sometimes those products cease to exist, that inavailability of a product could be quite costly for a consumer. Yes, if it's serial, even more so if it's access to credit that allows them to make investments and purchases that are going to have long-run flow benefits to them into their household.
I think an interesting thing that Jonathan said is that now there's no longer deference to the agency. So when Trump goes to eliminate these rules or fundamentally amend them, I think that they're going to find that that's not as easy as they thought. I don't know whether you...
Yeah, I mean, I think the business environment is just, in consumer finance, has become much more uncertain. Now, there's a lot of other economic environments where that has happened also. But it's not just uncertainty because policy flip-flops. In this case, it's uncertainty because there's a new policy in place that just may simply not stand up to legal challenges. And lack of enforcement is temporary. It can be enforced at any point. So presumably there will be a new administration at some point. And when that happens, they may turn back and go back and dig up all the data and start enforcing all of this stuff. And there may be some huge fines handed down. Or not, and so you kind of don't know exactly, and that's a big, difficult decision. In a competitive space, you have all this uncertainty, and different players will make different decisions and know how to move forward. I think if I had to think about rebuilding the CFPB, I might separate the enforcement and the rulemaking, because there is a sense in which sort of some of the themes that Paul touched on is that industry likes clean and clear rules. They want to know what the space is that we're competing in. And give me a clean, stable regulatory environment. I will design the best products and serve the customers the best. I will innovate in that space, et cetera. But when that also person is then enforcing, when you step over the guardrails and being the persecutor, if you will, the aggressor, the enforcer, that changes the relationship. And you had those two things somewhat separated. You could keep the smart rulemaking that's sort of cooperative with industry and consumers. It's not always in agreement, but people kind of can respect the research and the scientific process, and hopefully they get the answers pretty much right most of the time. And the policing version, and I think both of those are necessary, but bundling them may mean that now that what they've tried to do is throw out some of the policing, they've also thrown out some of the guardrail setting and simple rulemaking that has made the market reasonably efficient over the past decade.
Yeah.
Just to touch on that, Jonathan, is one of the complaints I heard from lenders was that basically, to some extent, they felt like with the previous administration, to some extent, the way the rules were just look at our last enforcement action.
Right.
Yeah. Exactly,
right? And so that's also, actually, in my opinion, that's not good process, of course, for rulemaking, as we know, in regulatory agencies. And ultimately, I think it does undermine then the rulemaking.
Yeah, and there's a lot of frustration with the CFPB. There's also, if you think of the crypto innovating space with the SEC, like just a lot of frustration with, well, can you tell us what the rule is here? And the regulatory agency being slow to move because of Administrative Processes Act, and also because they're trying to figure it out. And so the speed of issue is also an issue. Fintechs want to move fast. When you're creating new financial products or innovating, you want to get it out to the market. And sometimes you want a regulator who's more nimble, and that actually means a better resourced regulator rather than a worse resourced regulator where we are now.
Right. I think it's also maybe as a last summary of what we discussed, right? We need to differentiate the level of regulation and where a society, kind of wants products to be regulated. But I think what our discussion really highlighted is when you destroy or change a regulatory framework in a way where there is no clear understanding of where we will end up and how we will get there, it actually is not the same as deregulating, right? In fact, it's much worse than deregulation, because I think from everything we discussed, right, especially in consumer finance, trust is a very important commodity that financial institutions have, and the big ones and maybe the better ones have established over some time period. When you cannot trust the regulation of the market overall, it doesn't actually help new entrants, because then they have no transferred trust from the regulatory environment, and therefore, right, competition again will be hindered, because the people that are the most maybe risk averse and conservative will not want to try anything new, right? Because then now they can only trust the reputation of a big institution that has been around for a very long time period, and that you hope has a going concern and will be incentivized to stay on the right side of their consumers, even when the regulator doesn't necessarily enforce it. While all the small guys that are popping up, you don't know whether they are well-intentioned, or they're more of the, try something quickly and go away when it doesn't work, right?
So we should probably wrap up. So
Exactly.
Thank you all for attending, all of you who are online, all of you who are here today. This was an event sponsored by the Consumer Finance Initiative at MIT and the Golub Center for Finance and Policy. We continue to have a large number of events around campus. Watch the websites of both of these organizations for research and commentary on policy, consumer finance, and the financial sector in general. And really appreciate your participation, and thank you very much.
Thank you, everyone.
Thank you, Paul.
Thank you, Paul.